Hi, and welcome back to the Food Fund, where we analyze investing in food stocks, beverage stocks, and restaurant stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. Is one of the world's largest potato processors a good investment? In this video we will be analyzing if Lamb Weston stock is a buy. Could Lamb Weston, stock ticker symbol LW, be a good rebound buy? Let's find out. We have a lot to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on Lamb Weston. Lamb Weston was founded in 1950 by Gilbert Lamb on a farm in the Northwest United States. The company quickly grew to become a leader in frozen potato products, including crinkle cuts, hash browns, and even some innovative options like their stealth fries potato dippers. Additionally, Lamb Weston offers frozen sweet potato, appetizer, and vegetable products, making them a one-stop shop for restaurants and retailers around the world, including McDonald's and Chick-fil-A. Today, Lamb Weston is a global company, with products finding their way to freezers in over 100 countries. Now let's look at the price action. Starting with the 1-year chart, we see that Lamb Weston had a CAGR of about -23%. Zooming out to the 5-year chart, we see that Lamb Weston had a CAGR of 2%. Lamb Weston is certainly not a growing company, though this recent pullback may represent a buying opportunity. If we perform a backtest comparison of investing $10,000 in Lamb Weston versus the S&P 500, we find some interesting results for Lamb Weston. In that comparison with the S&P 500, $10,000 invested in Lamb Weston would have grown to $15,484 or a 9% CAGR versus $22,796 or a 17% CAGR if invested in the S&P 500. This demonstrates underperformance for Lamb Weston. A Lamb Weston investment would have also been more volatile, with a 29% standard deviation versus 18% for the S&P 500. Lamb Weston outperformed the S&P 500 in terms of the best year performance, for which Lamb Weston grew 43% versus S&P 500 31%, but had equal performance on the worst year performance, where Lamb Weston fell 18% versus the S&P 500 18% fall. In terms of max drawdown, Lamb Weston fell 42%, more than the max drawdown of 24% for the S&P 500. Lamb Weston did underperform the S&P 500 in comparisons using the Sharpe ratio and the Sortino ratio due to its excess volatility. Of note, this backtest comparison does not include the massive drawdown that occurred on the 4th of April, 2024. Now let's hop over to market share and take a look at Lamb Weston's market share. Here we have the dashboard, where we can quickly gather a lot of information at a glance. Expanding the dashboard, we can look under food and see that Lamb Weston is categorized under packaged food. Expanding the packaged food tab, we can see that Lamb Weston is one of the only packaged food companies that has gained market share over the years. Let's look closer at the year-by-year changes in market share. So we come down here and type in the ticker symbol for Lamb Weston, ticker symbol LW, and see that the market share is 0.67% out of the publicly traded food, beverage, and restaurant stocks currently in the market. Lamb Weston is a relatively small company, but it is gaining market share. The 5-year market share CAGR for Lamb Weston is 6.1%. If we start in 2019, we see that the market share was 0.53%, 0.53% in 2020, 0.44% in 2021, 0.44% in 2022. And rose to 0.67% over the trailing 12 months. We can see that Lamb Weston's position was disrupted a bit during the years of the highest inflation, 2021 and 2022. However, market share gain was restarted in 2023. In this version of market share, we can also compare Lamb Weston with other companies or entire industries. When we compare the market share data for Lamb Weston against a peer company like Dole, we find some interesting results. Lamb Weston generates 43.49% of the revenue from a basket of those two companies. Interestingly, Lamb Weston seems to be losing market share to Dole at a rate of 2.26%. Let's take a look at the fundamentals to learn more. Gross margin is 28%. This is on par with expectations. Revenue has compounded at around 12% over the past 5 years and has reached over $6.6 billion most recently. We can see that Lamb Weston benefited from the inflationary period that started to take off in 2021. Looking at cash flow, we see a 6% CAGR over the last 5 years for operating cash flow, while capex has worsened at a 27% CAGR. As a result, free cash flow dipped negative over the trailing 12 months. Despite operating cash flow, expanding capex is eating into what would otherwise be good free cash flows. Weighted average shares outstanding have fallen over the last 5 years, going from 147.3 million shares in 2019 to 146 million shares most recently. Lamb Weston has been buying back shares. Unfortunately, the share buybacks have reversed over the past few quarters. Now let's view return on invested capital. Return on invested capital has fallen from 21.9% in 2019 to 17.8% in 2023. This is not good news. Lamb Weston has become less efficient in driving profits from its investments, though this trend bottomed in 2022. Another favored metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from 60 days in 2019 to 72 days most recently, Lamb Weston has gotten less efficient over time. Unfortunately, that trend is worsening. Now, let's look at Lamb Weston's debt. The net debt to EBITDA was unchanged over the past 5 years, going from 2.8 in 2019 to 2.8 most recently. It seems the company took on more debt in 2022 but has been paying it down since. Last, let's explore dividends. Current dividend yield is 1.4% with a dividend payout percentage of 16%. Lamb Weston is paying out dividends that its earnings can support. This indicates that the company's dividend practice should be sustainable. Dividends per share for this company have grown at a 9.1% dividend per share CAGR over the past 3 years and a 9.2% dividend per share CAGR over the past 5 years. This is a pretty decent dividend per share growth rate. The fundamentals of Lamb Weston are fair. In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Lamb Weston. It is a food company with a gross margin of 28%. The 5-year revenue per share CAGR is 13% and the 5-year free cash flow per share just flipped negative. While the strong revenue growth and decent gross margin are positive, the negative free cash flow is a red flag. A return on invested capital of 18% is okay but does not seem to be growing. Next, the cash conversion cycle of 72 days is rather high. Concerning debt, a net debt to EBITDA of 2.8 means that it would take Lamb Weston nearly 3 years of earnings to pay back their debt. So from a fundamental standpoint, Lamb Weston looks fair. Not good but not horrible. Now let's switch our attention over to valuation. Lamb Weston is massively undervalued relative to the S&P 500 with a ratio of 0.4. The price to earnings growth, or PEG ratio, is 0.7, indicating that Lamb Weston is undervalued relative to their projected earnings growth. Lamb Weston is one of those companies that plays a big role behind the scenes. So many restaurant and food companies use it as their potato supplier, and I don't see French fries going out of style anytime soon. However, Lamb Weston's good revenue growth is not trickling down to free cash flow because the company is aggressively investing in capex. It is unclear how or when investors might expect a return on this investment, but it has not borne out so far. A Yahoo Finance article gives more insight into what caused the recent share price fall. Following its quarterly earnings report, the share price fell 19%. Even though sales grew 16% year over year, both revenue and earnings came in below expectations. Despite this, the relative undervaluation may represent a buying opportunity for interested investors. In my opinion, there is just not enough promise for me to justify the risk. For me, Lamb Weston is not going on the watch list, but I do look forward to reviewing this company again in the future. Many thanks for watching. What do you think about Lamb Weston, and please be sure to let me know what other companies you want me to analyze. Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.